Right now, we're going to welcome our first guest with our top story of the day. We've got John Kingston, our editor-at-large, and our oil and gas expert. And John, thank you for joining us this morning. You dropped a super interesting 7 a.m. story yesterday morning about the really growing disparity between gas prices, crude, and diesel.
Yeah, well, thanks to my longtime friend Phil Verliger, who's an energy economist who's always kind of focused in on diesel as a market. And he kind of laid out in a piece in his weekly report about a week and a half ago why diesel has been rising so much more than the price of crude or the price of gasoline. And what he's saying really is that it's structural. It's nothing that's kind of short term that's just going to disappear. And everything that's happened in the market now has exacerbated these conditions. I mean, the one short-term factor that he does cite is Russia-Ukraine. Russia is a major supplier of diesel, or what are known as blend stocks to make diesel. So that's obviously a short-term factor. But diesel has been undergoing environmental tightening for several years now to remove sulfur from it. And Phil's view was always back in 2008, when the crude price hit its all-time high, that was a function of Europe desulfurizing its diesel, that it's expensive and it tightens supplies. And he's seeing that now as well. One thing I was very happy to see him cite was the IMO 2020 regulation. Now, if I was on FreightWaves now back in 2019, I would have been talking about IMO 2020 all the time. It's a rule that requires much lower sulfur in marine fuels, the fuels that make ships go. And when it was pending, went into effect on January 1st, 2020, when it was pending I won't go into all the geeky reasons why, but because of the way you made IMO 2020, it was feared that it was going to really tighten up the diesel market. There were some signs of that as we kind of moved into 2020. Then, of course, the pandemic hit, demand collapsed, and we never really got to test this theory. But one of the things that Phil brought out in his report is that he feels that IMO 2020 impact is really starting to be felt now in the market, and it's a factor. And some of the gaps in prices are just out of this world right now. There is a weekly EIA, DOE EIA gasoline number as well as the diesel number that's used for fuel surcharges. About a year ago, that spread was 38 cents. More recently, it was like $1.20. So the idea that diesel has soared well above the price of gasoline and well above the price of crude, beyond the gains in both of those, is not a mirage. It is very real.
Thank you, John. And I'm curious to know what you'd think if this were to get worse, what might happen to carriers or what might happen to the futures market for those that are hedging.
Well, I mean, if they're hedged, they're probably doing pretty well. Good for them if they've hedged. But quite frankly, it's tough for carriers to hedge in the market. That's one of the reasons that we were looking at a freight futures contract. It's pretty expensive to tie up that much capital. So you really most of them don't. And they view their hedges as the fuel surcharge. It's going to be the shippers that mostly pay this. But, an independent owner operator, when they go out and they book a rate, that doesn't usually have a fuel surcharge in it. The assumption is that they will book a rate that will account for what they expect to pay for fuel. Well, the problem is, of course, that fuel's been rising so fast that a rate booked, a week ago, when they drive up to the pump, the cost that they're going to be paying at the pump is going to be far more than they anticipated in that rate that they agreed to. That's where it's going to be putting the squeeze on. And then, there's anecdotal social media posts about, hey, I just can't do this anymore. The freight rates are killing me, so I'm just going to go off the road for a while. I saw somebody yesterday put up something about shrimping boats in the Gulf of Mexico staying in dock because they can't afford the diesel. This is demand destruction, and this is how, unfortunately, markets that are in tight supply balance. The other thing you've got going on is this week you've had a tremendous squeeze in the price of ultra-low sulfur diesel on the CME commodity exchange. Right now, we are trading barrels. The front month that we're trading is for a May barrel of ultra-low sulfur diesel delivered in New York Harbor. That contract goes off the board today. And the problem is that people who were short are paying up massive dollars to get out of those positions because the supply just isn't there. And what's happening is that apparently, this does look like it's starting to make its way into wholesale levels, and it's making its way, therefore, into retail levels. So the users of diesel are not going to end up paying 100% of this squeezed price, but they are going to get hit here. Now, on Monday, the May contract that was getting squeezed goes off the board, and the June contract will come in at a lot lower. You're not going to get a rollback in prices. And all I can say is this. that for people who price diesel for a living, they have no more hair left. Either they fell out or they tore it out because they have never, ever gone through a market like this before.
So, John, that point about demand destruction and the prices kind of being that path to normalizing the fuel markets overall, something that you've brought up, I guess about a month and a half ago now when we started to see this incredible increase in the fuel markets. Can you talk about how long you would expect this demand destruction to take or to last in the markets? Could we be looking at some type of recovery before summer or sometime in the middle of summer, or is it just too early to tell?
It is too early to tell because we're not sure what's going on with the supply side. But I will say this, that I think probably what I said in previous visits and when we discussed this is that markets will balance. They will find a way to balance supply and demand. They have to. None of them in a market like this are pleasant. You can pull a lot of oil out of inventory to meet your supply deficit, but the market knows when that happens and it boosts prices as a result. You can destroy demand, but demand destruction means usually the prices are so high that people stop using diesel, like those shrimpers I just spoke about. That's painful too. That can involve people losing their livelihoods. So demand destruction is a way of getting to a balance. The market will find a way to balance, but it's kind of ugly getting there. And when it's going to end, I just don't know. I'd like to get to next week and get this squeeze kind of out of the way and see what the market does after that. Because even though the squeeze is in the May contract, it will tend to drag up some other prices with it. So I want to see what happens next week when the squeeze is out of the system.
Absolutely, John. Now, we had Elaine Levin, the president of Powerhouse, on yesterday, and she talked about how this could affect people on the coasts more than in the middle of the country, because those in the middle are getting domestic supplies, and those on the coast, of course, are getting imported supplies that could cost 60 cents more. Who, in your opinion, does this hurt the most?
I don't agree with that philosophy. Okay, I mean the diesel market is a global market, and supplies. Surpluses one place will move to areas of deficits in others, and it'll all tend to smooth out. There's no way that the middle of the country is going to pay 60 cents less than the coast. I mean, of course, California is its own thing because they have their own special blend of diesel. It's a lot more expensive to make, so forget that. But let's just talk about the East Coast. The middle of the country is not going to pay significantly less diesel than the East Coast because what happens is even though some of the domestic crude prices are cheaper in the middle of the country, because you can export diesel and because you can import diesel, essentially the mere act of being able to connect to the world market through imports or exports normalizes the price everywhere. So I just don't agree with that theory.
That makes sense when you put it in that perspective. And then I know that you mentioned that in your colleague's piece that this was kind of happening before the impacts of the Russia-Ukraine conflict, but now we're seeing developments where Russia's talking about cutting off the supply of natural gas to its European Union neighbors, and then that could cause more reliance on diesel fuel as well. Is that going to be kind of the next step forward in putting more strain on the diesel market?
Yeah, and that really was putting strain on the price of natural gas in Europe long before the war had gotten to crazy levels, like back at the end of last year and early this year. And I mean, this wouldn't happen in the U.S. right now because the price differential between natural gas and diesel still remains fairly wide. Because natural gas, we've got a lot of it here, and it does tend to keeps the price relatively in check, relatively in quotes. But yes, in other parts of the world, they are turning to diesel in place of applications where natural gas has gotten so high that they really just feel they can't use it anymore. And diesel, as expensive as it is actually seen as a cheaper feedstock. Not so much cheaper feedstock, but a cheaper energy source, like to make electricity or in some kind of industrial use. So yeah, that's putting strain on the diesel market as well. And as I said, the diesel market is global. So what goes on in Europe does impact back here in the U.S.
Well, thank you so much, John. We've enjoyed having you on the show. Is there anything else that you think you'd like to mention on the topic before we go?
We'll talk next. Well, of course, next week we'll be talking about the employment report that comes out on Friday. But if we talk about diesel next week, we'll see how different the conversation is. The squeeze will be in the rearview mirror, and we'll see what the June contract is doing on its own.
All right, John, thank you for that. We'll catch up with you again next week to talk employment numbers as that employment report comes out the first Friday of the month.